Everyone's doing well. Welcome back to another video. Today we're going to be going through trading with order blocks and mitigation. The first and the most important point, this video will not make sense to you, or at least not properly, if you don't watch my last video. You need to watch my last video and understand the concepts before you can learn how to apply them. But today, the point of this specific video, I'm not giving you something that's exhaustive. I'm not going to show you how to trade with all order blocks and every time mitigation happens. I'm going to give you a simple strategy that a lot of people commonly use. If you're from Twitter, UK crypto Twitter, a lot of people use this strategy or something very similar to it, or something along the same lines. So if you can wrap your head around the strategy that I'm about to teach you now, then you should get a good grasp and general understanding of how order blocks work and how you trade them, and then you can start to apply it to different strategies and even different variations of the same strategy. So let's get into it. So there's only 4 points here, so it can't be that complicated, right? But like I said, if you haven't watched my previous video, then the whole concept of what order blocks are will not make sense to you yet. Okay, so the first step is identifying your order block, right? You want to get on your chart, you want to look at your order blocks, or not at your order blocks, but look at what's in front of you. Try to identify any current order blocks on your chart. By current order blocks, I mean order blocks that were relatively recently created. It depends what sort of time frame you're trading on. If it's a small time frame, let's say 15-minute and under, or even 30-minute and under, you want to look at your recent order blocks that have been created because you can trade off of them. In regards to bigger order blocks and higher time frames, 4 hour, weekly, daily, whatever, I'll get into that in a second. You identify your order block, you wait for something called a break of structure. So initially when I was learning these concepts, break of structure was a concept that I struggled to wrap my head around, but you wait for a break of structure, then you have something called mitigation, which I speak about in my last video. The mitigation point is when we enter, and then after that we target highs or lows as our take profit, or at least that's how I do it. Like I said, this isn't exhaustive, but this is just a strategy and how I essentially use order blocks and all these things in conjunction to make my trades. But let's get onto the chart so it's easier to see. Okay, so this is the 5-minute FTM chart, right? The first thing you have to look at is market structure. So by market structure, what I mean, if you go onto my Instagram, I've got a little post on this that should make stuff a little bit clearer. But clearly here, market's going up. So essentially what's happening is we're forming good higher highs and higher lows is what we call them, because this means we're in a bull trend, we're getting up, right? I wasn't meant to do that. Okay, so essentially over here is a high, high, low, high, low, high, low. And of course here is a high. So now if I just get rid of this, okay, so over here is our order block. The order block is our green candle. So if you've watched my last video, this will make sense. We speak about the order block being essentially the last push up before a move down. So that's in simple terms at least. So usually we do draw a fib on it, but for now, I'm just going to draw something like this. Okay, so that's an order block. Okay, so that same structure that I drew out before, let's just add a little bit of it on, right? So from here, come up, come down, come up, right? So now what this means, over here is our previous low. Line's a bit bent. This is our previous low, right? So let's just go across. That's our previous low. Usually I use candles, so I'm gonna be waiting here. Okay, so that's the previous low, right? So what I mean by I use candles is this is our market structure break. So let's mark this up. So break of structure, right? Why is this the break of structure? Price was not meant to go below this level. If you're in a bull trend, you're meant to see high, low, high, low, high. So essentially what I was saying before, high, 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 low, high, 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 low. So here, where price should have been putting in a high, low, potentially somewhere here even, and then pushing up again, what's happened is price has come and it's broken this low. So when you've seen this breaker structure, we can identify our order block. You can identify your order block already, but usually you can just look at the market structure. If there's a break, you can go back and see, okay, here's an order block. So this is a 5-minute order block, right? So now that we've had a breaker structure, what do I expect? I expect price to come back here. And when price comes back here, I expect a reaction, right? Okay. So if we draw in our short position, here's the simplest way to do it. This is your entry. Where this candle started, where your order block started is your entry. Your stop loss goes just above the previous high. So by previous high, what do I mean? There's a wick here, so our stop loss goes just above that wick, right? Okay. Then your take profit, this is where I used to struggle a little bit actually. In terms of your take profit, over here we have something called equal lows. So what you can do is target these equal lows. What you can do is put your target as somewhere down here. If you want to be conservative, you could have done less. You could have said, I don't know, let's just say somewhere like here. And you have a 1 to 1.5 trade, you have a 1 to 2, whatever. It depends on your strategy. You can play around with this stuff and mold it to what you want. But me personally, I would have put it down here, yeah, around here. So that would have given me about a 1 to 3 ratio, as it says there, 1 to 3.25. So that's just the simplest way to trade an order block, right? So what's happened here? So we've had our market structure, it's going as normal. We have a market structure break, the breaker structure over here. Then now we're expecting so once we've had the breaker structure, we have an order block. We're looking at this order block. Now that we've identified it, we've drawn it up, what we can expect is price to return here and price will react. Price is going to react bearishly and then come to this point and then bounce down. So here's another thing you might see people do. You might see people drawing something like this on their candles, right? So people drawing the Fibonacci retracement onto the order block. Some people draw it on the whole thing, some people draw it on just the body. I use just the body. So here, what some people may do is enter at the 0.5 instead. So if you watch my last video, I speak about something called mean threshold, which is why an entry at the 0.5 can make sense, right? Some people will just enter at the open, and the benefit of entering at the open means that you're in the trade regardless. Let's just imagine price goes from here, goes up here, and you entered where price is now, and then, you know, let's just say it does something like this. Comes to your take profit. Cool. What that means is you would have had a little bit of drawdown if you entered here at the open, but you would have still been in the trade, and you would have still had your take profit hit, and you would have had this 1 to 3 ratio trade, which is fine. Me, on the other hand, usually, not always, usually I will enter at the 0.5, and that would have given me here a 1 to 6 setup. Of course, this hasn't played out yet, but if this plays out how I expect it to, then I get a 1 to 6 trade. So my point is that you can enter at either point and still potentially have a profitable trade. If you want a higher RR, you can enter up here. And of course, if you enter down here, you have a lower RR. But the point of entering lower, you're more likely to get into the trade. Because sometimes what price might do is, you know, it'll come up here to, let's say, like somewhere random like that. It won't hit your 0.5 and then it will just reverse. But it hit the entry, so as in it hit the open of the order block. But if you don't take that trade at the open, then clearly you wouldn't have been tapped in and you wouldn't have been able to, you know, get your profits from that trade. So that's about it really in terms of on what the strategy is. I hope all of that makes sense. I'm just going to talk about a few other points back in the presentation now. So first of all, the third point is exactly what we just spoke about, conservative entries. I enter at the 0.5. You could consider that conservative because it's less likely that price will always go there. If you go on the chart, you backtest it, you'll see that. But more often than not, price will go to that open of the order block and then bounce off, right? So if you always enter at the open, you're more likely to get into trades. First point, oversimplification. Like I mentioned at the start, this is just one strategy, and everything I've said is very oversimplified in the sense that, in terms of your bricks of structure, is it valid, is it not? That in itself is a whole other topic. I might make a video on that. It is a bit of a confusing topic, so potentially, but your order blocks, there's different types of order blocks, they act in different ways. So this, what I've shown you guys today, is just for you to kind of get a very foundational understanding of what's going on when people are trading with order blocks, when people are talking about break structure and all of that stuff. So then now, if you have a foundational understanding where there's gaps or where you want to improve, you can kind of like pursue that yourself and start learning different things, right? The second point, very important, top-down analysis. So what that means is starting on a high time frame and coming lower, right? Let's imagine you're trading on the 5 minute and I don't know, you take a long, so you're bullish in the 5 minute chart, right? And then you go to check your 1 hour chart, or I don't know, let's say even your 30 minute chart, and your 30 minute chart is bearish, or we're very close to 30 minute order block, let's say. So what I'm getting at is you need to check all your time frames, not all of them, but at least some of your higher time frames to have a clear understanding of where price is actually going. Because price can be bearish on the 4 hour, but if you're on the 3 minute chart, you can still catch a long and make profit, if that makes sense. Because it just because the 4 hour is bearish doesn't mean everything is going to be bearish as well. You have to just look at it relatively, but you need to bear that in mind when you're building your trades, because if you don't bear that in mind, if you don't include it in your setups, it's very likely that you're just going to keep, well, not randomly, but you're going to think randomly getting stopped out and then whatever. So just bear that in mind. But that's about it from me. I know this is a confusing topic. I know I might not have explained it as well as some people might have wanted, but hopefully in the upcoming videos I can get into a bit more detail over time. If you have any questions, my socials, everyone has them now. Just message me anytime and I'll be happy to help and answer any of your questions.